The stock market has officially flipped.
Is America heading towards a recession?
I mean, if you looked up disaster in the dictionary, you'd see Intel's ticker.
The unemployment rate jumping to 4.3%. That is the highest level in nearly 3 years.
The central bank holding interest rates steady yesterday for the 8th straight meeting, opening the door to a September rate cut right before the presidential election.
Major investors are dumping stocks as the Nasdaq officially entered correction territory on Friday. Warren Buffett, for example, just sold roughly half of his entire position in Apple even after they reported a record quarterly operating profit. We're going to dive into what's causing this major market sell-off, but first, let's take a look at some individual stocks that have been hit the hardest. First off, we have Intel. This stock had its worst trading day since 1974, with the stock selling off over 26% after reporting earnings. This alone evaporated about $30 billion of value for the tech giant. The first reason behind the sell-off here is layoffs. Intel announced that they would be cutting about 15% of their workforce as part of a $10 billion cost-cutting plan. In addition, Intel admitted that they've been unable to keep up with important trends like artificial intelligence. In the second quarter of 2024, Intel reported a massive $1.6 billion net loss, and that compares to net income of $1.5 billion in the same quarter of last year. Intel stock has been on a nosedive since the end of 2023, and the total loss for the stock from all-time highs now stands at just shy of 58%. And keep in mind, this isn't just some random tech growth stock. Intel is part of the Dow Jones Industrial Average, which are 30 prominent US blue chip stocks that are viewed as industry leaders. If this trend continues, this could potentially jeopardize their position in this prestigious index. Next up, we have Amazon. Amazon stock dumped just shy of 9% on Friday after reporting earnings. This was the biggest single-day drop for Amazon in years, erasing $134 billion in total market value for the e-commerce giant. While there are broader catalysts for this big tech sell-off that we will be covering shortly, Amazon missed revenue estimates for quarter 2 of 2024. Revenue was expected to come in at $148.5 billion, but Amazon ended up reporting revenue of $147.9 billion. But this $600 million revenue shortfall is not what caused this massive sell-off alone, because keep in mind, the stock market is forward-looking. Instead, it was largely due to weak outlook for the third quarter of 2024. For quarter 3, Amazon estimates that revenue will come in between $154 to $158.5 billion, compared to analyst forecasts of $158.43 billion. In addition, operating income is expected to come in between $11.5 billion and $15 billion, compared to estimates of $15.2 billion. While the cloud business beat revenue estimates and earnings per share came in well above the estimates, Wall Street was still solely focused on the forward-looking guidance. From the peak in July, Amazon stock is now down about 16% overall. Continuing the trend here of the big tech sell-off is Microsoft. Microsoft reported solid earnings for the second quarter of 2024, with revenue and earnings per share that beat Wall Street estimates. However, a slight miss in the cloud business, specifically the intelligent cloud segment, led to a sell-off taking place. Microsoft stock initially sold off 7% after reporting earnings after the bell on Tuesday, but has since recovered slightly. Overall, Microsoft stock is now down 12.5% from the high in July. But this market sell-off is not just limited to big tech stocks. In fact, major US banks took a huge hit on Friday as well. Bank of America stock dropped almost 5% on Friday, bringing the overall drop to 15% from the highs of July. This was partially due to Warren Buffett also selling off billions of dollars worth of Bank of America stock in addition to Apple stock. This banking-related sell-off also affected Wells Fargo, which dropped almost 6.5% in Friday's trading session alone. So what is actually causing this major sell-off in US equities? The first and biggest reason behind this major market sell-off is the jobs report that came out on Friday. In July, 114,000 new jobs were added as compared to 179,000 in June and 216,000 the month before that. Overall, job growth came in much lower than expected, and this sparked significant fears of economic slowdown. Over the past 12 months, the average figure for new jobs created monthly has been 215,000. So this July figure of 114,000 100,000 new jobs created is roughly half of the average over the last 12 months, potentially indicating a significant slowdown in the labor market. In addition, the overall unemployment rate in July ticked upward to 4.3% compared to 4.1% in June and 3.7% at the beginning of the year. Unemployment came in at the highest rate since October of 2021, bringing about significant concerns of a broader economic slowdown. And this leads us into the second major reason for the market sell-off, and that is interest rates. With clear indications of economic slowdown present and inflation cooling off, many expected the Federal Reserve would finally cut interest rates at their latest meeting. However, at the latest Fed meeting on Wednesday, interest rates were held steady at the current 23-year high. During this higher interest rate period, the Fed has been pointing to a robust job market as an indication that the economy was strong. But the last 3 months of data points to a potential trend reversal in the job market. Now, many have criticized the Fed in the past for being too slow to respond to the high inflation caused by the pandemic spending. Now, there are many who are concerned that rates have been held too high for too long, forcing an economic slowdown to take place. Inflation is cooling off, with the latest reading being 3% compared to 3.3% in the same period of last year. However, this is still well above the Fed's long-term target of 2% inflation. Now, there was indication that the Fed might cut interest rates as soon as their next meeting in September. This would be a benefit for the overall economy, as it would lower borrowing costs for Americans across the board for things like credit cards, auto loans, and even mortgages. But right now, the Fed is stuck between a rock and a hard place. If they cut rates too soon, this could cause inflation to reverse its current trend and begin increasing again. But on the other hand, if they wait too long, this could potentially force an economic slowdown to take place and potentially push us into a recession. The next jobs report, as well as CPI report, will be a major catalyst for the stock market, be it a good one or a bad one. Now, the final reason for this major market sell-off ties back in with the big tech stocks, and that is overall AI disappointment. Almost every major company out there is trying to jump on the artificial intelligence bandwagon, and this is resulting in significant spending. Nvidia has undoubtedly benefited the most from this AI trend, and all of the big tech companies are trying to follow in their footsteps. But this is resulting in billions of dollars being dumped into AI advancements. However, the AI buzz is wearing off for Wall Street, and all of that spending is now being looked at as a hindrance on earnings. These investments in artificial intelligence technology won't bear fruit immediately, and investors are losing patience. In addition, the valuations for the Magnificent Seven have climbed so high that they've become priced for perfection. And when that happens, a major sell-off is nearly guaranteed when there is even the slightest whiff of bad news. So that's what's happening in the stock market right now. Ultimately, where things go from here comes down to the Federal Reserve, as well as the next jobs report and inflation report. But let me know what you think about this down in the comment section below. If you enjoyed this video, make sure you drop a like, as well as subscribe and hit the bell for future notifications. You can click below to watch my latest video, and I'll see you there.